Recording.
Okay, welcome to Sacred Account Saturday. It's good to see everyone today. My name is Jerry Fetta. I'm the owner, founder, and CEO of Wealth Dynamics. And I'm coming to you live this Saturday on Facebook. I think I'm going to stream this on Instagram really quick as well. I'm coming to you live this Saturday to talk about what to do about bank failures. Okay, so let me get Instagram rolling here as well. Let me just put a title on here. So this is going to be about how to protect ourselves from bank failures, right? And if you've not been paying attention, most of you probably already have seen in the last 2 months. Okay, last 2 months, we've had 4 or 5 major bank failures in the United States. We had Credit Suisse, the largest bank in Switzerland, fail about a month ago. So it's something that I want to talk about because I think it's very similar to what we saw happening in 2008 financially. I do want to go over solutions and talk about what we can and should be doing about it. And also having solutions means that we can help other people, right? And so this is a great time for those of us that are, Wealth Dynamics clients who are, tracking with, the solutions that we offer to be able to actually, go help, be a word of stability and a voice of stability. So let me put this live on Instagram as well. Okay, perfect. So we are recording in live. So again, Jerry Fetta here, owner, founder, CEO, Wealth Dynamics. As we're doing this course today, there's a couple things I want to start with. Okay, so first things first is the main kind of chief point is have a purpose, have a reason for being here, right? It's very hard to learn. It's very hard to get information on something if we don't know why we're watching, right? So if you just tune in on the live stream, if you're watching here on Zoom, if you're on Facebook, if you're on Instagram, if you're watching the replay, we're learning about finances today. I'm going to be talking about the bank failures that have been happening and what you can do about it. But I need to make sure that as a teacher, my audience, you guys that are watching, you have a reason to watch this. Like, why are you here? What do you want to get out of this? Right? Most of us, an easy one is most of us do have money inside the banking system. Right? And so with that being said, I think it's very important for us to understand what's happening to it while it's there. Right? Now, the second thing is, after having a purpose, I want to get rid of the idea that money is confusing and hard to learn about. Okay, finances are literally come down to math and basic vocabulary. So if you know how to use a calculator, if you know how to use a dictionary, the ability to understand finances is there. Right? And so what happens is we have, these complex problems in our lives that we solve with financial tools, financial investments, financial vehicles. And, Wall Street and the banking industry typically like to overcomplicate those. They like to make them seem more confusing than they really are. Right. And so we get these big words and these, really, complicated sounding, I call it nomenclature, but specialized financial language. And the average person hears that stuff and then they're like, I don't know what that means. And then they bring that up with the conclusion that money must be hard. Money must be difficult. Finances must be hard. Therefore, I need to hire a professional because I'm never going to understand this stuff by myself. And so we never try, right? And so the reality is that word has a definition. If you get a financial word, there's a definition of that word, right? A great resource is called investopedia.com. That's an online financial dictionary that anyone can go use for free and learn about financial words. And then beneath that word is typically going to be a mathematical concept, right? And that math is generally going to be, addition, subtraction, multiplication, division, right? It's not super complicated. So if you have a basic investment calculator, you can start understanding the math behind finances as well, right? And beneath that math is usually a tool or concept, right? And that concept is usually trying to solve a problem. And so there's the layer of there's a problem, there's a solution to the problem. That solution to the problem is going to be represented by some kind of basic math, and there's going to be a word attached to it that, in the modern sense is probably going to sound like it's very complicated when really it's not. We break these definitions down. So I remember when I was 18 years old, I'm turning 31 next month, but when I was 18 years old, I had a mentor of mine tell me, Jerry, and he was in the financial industry. It's right when I got started. Okay, and he told me, Jerry, the only difference between me and you is our vocabularies. That's the only difference. He's like, Jerry, the only thing that you know that I know that you don't know is what these words mean. As soon as you learn the words, you're going to be right up there with me. And so I want to give you the encouragement today that as soon as you understand the words associated with money, with finances, it becomes very easy to learn. Okay. But the other one, the third one I want to cover before we get started with our material today is the idea that we know it all already. Okay, so much of our lives financially, they operate on what's called a fixed idea. A fixed idea is a belief that we got from someone else. We didn't inspect it to find out if it's true or valid or workable. We just assumed that it must be because of who told it to us. And then we operate with it in life and we struggle and we never go back and check the fixed idea. So just like going to the gym, right? I've got my first form bottle here. I'm going to the gym after this. Just like going to the gym, it's not something you did, it's something you do. Right? And if I'm doing it, I should see results. And so when it comes to financial education and financial knowledge, it's not, I've heard this before, or I've seen this before. It's, what are my results? What are my results? Are my results there? If they're there, then I have knowledge. If they're not there, then I must not have knowledge. Right? Knowledge is evidenced by results. If I'm not able to use and win with the information, I don't actually have knowledge, no matter how many times I've heard someone say the thing, no matter how many books I've read, no matter how many podcasts I've gotten. Right? So results and knowledge are different. Okay. And then the final point I want to make today is I want you to think about how to use the information today. Okay. When I was 18, 19, I had another mentor give me the idea, and I use this even to this day. If I learn something and I don't apply it or share it with someone else within 24 hours, it's gone. I'm never going to see it again. Right? Now, that's not real. Obviously, that's not real. But what that does is it creates a game of when I learn something, I need to implement it quickly. I need to teach it to someone else, or I need to use it. And so I want you to have that today as you're learning. Right? Just like with fitness, we can become obese by consuming more calories than we burn with our bodies. You can do the same thing mentally. You can become intellectually obese by all you ever do is learn, consume, read, listen, watch, and then never use. And it doesn't matter how much learning we do. If we don't actually use it, we do become intellectually obese, right? And it makes us less likely to use future information because we have a backlog of other information that we never actually used yet, right? So these are all the points I want to cover. Now, as you're on the webinar, if you're on Zoom, we do have my team here as well. So there's a couple of people that are panelists here. There's going to be Bree Shaw. There's also going to be Jules Allender. They're both endorsed wealth mentors for my team. And so they're going to be reaching out to you in the comments today to connect with you. And so as you're getting, messages from them, realize they will be reaching out. They're going to be looking to set up a call with you. Guys, what they are here to do is help. Okay, Bree and Jules, their number one mission in life is to help you with your finances. Like when they're on this webinar, they're not here to attend and learn so much as they're here to make sure that you're learning and that you're able to apply the information. This goes for if you're on Instagram, if you're on Facebook, if you're watching the replay, whatever it might be, this goes for you as well, right? Like if you're learning and you're like, hey, I want some help, reach out to our team, right? So that's going to be Bree and Jules. And then finally, as you're watching this, I do want to make you aware of a free offer you can take us up on today. So I'm going to share my screen here. And if you guys are on Instagram, let me see if I can flip this around for you. Here you go. So this is a copy of my book. This is called Blueprints of Financial Freedom. Right. And so I'm going to be giving away a free copy of this. If you're not a client of mine and you want to learn more about what we do, if you go to jerryfetta.com/B2F promo, B2F PROMO. Okay, B2F promo, you can get a free copy of my book. You cover your shipping, we'll send it out to you. And basically, this is going to give you a lot more than we can cover today on the webinar. Right, this is going to give you everything you need to know in order to get started in building your financial future. So this is called Blueprints of Financial Freedom. This is based on over a decade of research that I have done in my own life to learn about finances and study what are the top 1% historically actually doing with money. So I could apply those in my own life. And the result was I was able to build a multi-million-dollar net worth before the age of 30. I have a 7-figure business. I've been able to build investments and earn passive income and do all sorts of great stuff. And even to the point of, last year I had some losses. I'm able to rebuild those very quickly because I know what to do. Right. So that's a copy of the book, and you can get that free today by reaching out on the webinar. Just let us know, if you want to grab the book, you can message Jules, you can message Bree, you can drop something in the comments, or you can just go to the link, which Joe, if you could post this in the chat for everyone, jerryfetta.com/B2F promo, just for the free book. And then finally, before we dive in, I do like to keep these interactive, right? So if you have questions, if you want to go live with me, whether you're on Instagram, whether you're on Zoom, let me know. I love miking up, answering questions, going over maybe goals you're trying to achieve, problems you're trying to solve with your finances. Right now, without further ado, I want to jump into our topic, which is going to be how to protect ourselves from bank failures. Right. And just to give you guys some data on this, just so you're all on the same page, in like the last month or two, we had Signature Bank fail, we had Credit Suisse Bank fail, we had First Republic Bank fail, we had Silicon Valley Bank fail. I think there was another one that just got released. We're seeing this ripple effect of bank failures, right? And this is not like your small little tiny community bank down the road failing. Like this is like very large institutions, like two of them that failed. It was the second and third largest bank failures in US history. Right? Like even in 2008, like we didn't see this many bank failures, right? Which makes us wonder, like, what's happening? When something big like this occurs, we wonder what's happening. And it reminds me of 2008. Who remembers 2008 during the mortgage crisis? Right? We had all of these companies investing in subprime mortgages and getting involved in subprime mortgages, meaning they were loaning money to people for houses that couldn't afford it. The credit score wasn't being checked that well. The income wasn't being verified. They shouldn't have been getting home loans, and they were getting home loans. And the banks were doing this and then selling it to Wall Street. Then Wall Street was selling it to us. And then everyone was losing money at the end but Wall Street, right? And the commonality between that is, when Silicon Valley Bank failed, this was the first bank that went down this year. They failed because when you deposit money in a bank, that bank actually invests your deposits. Think about this, and I'm going to go over this concept today, but they invest your deposits. When we give money to a bank, we give it to the bank with the expectation that they're going to keep it and save it for us, and we're going to have it for later. Okay, but right now, the law, the federal law says that they can keep 0 to 2% of your deposits in reserves, meaning they're going to get rid of and loan out and invest 98 to 100% of your money. It's not there. Okay, they're making 400 to 1300% on dollars that you deposit in the bank that you and I put in there. And they're paying us 0.34% interest on average in a savings account. So they're carrying none of the risk. They're getting all the profit. They're paying us nothing. We're taking on all the risk with our money, right? And what happened was, like with any investment, when the bank takes our deposit and loans it out or invests it, there's risk there, and they could lose that money, and that money belongs to us. So they could risk and lose our money, which is what happened with Silicon Valley Bank. The depositors got wind of it, and they tried to withdraw their deposits, and they couldn't. It created a run on the bank. Okay, so in the banking world, most banks keep only about 30 days worth of reserves to survive a stressful financial situation where they've got more than the average amount of depositors taking money out. Right? That's a month. Like the average bank, they're going to last a month through something like that. Okay, so it's not that much like of a far stretch to think, okay, these banks, they're loaning out deposits. They don't have the reserves. If we all took our money out, they're going to last about a month in business, and otherwise they're going to go out of business. Now, in the case of Silicon Valley Bank, over 90% of their deposits were not covered by FDIC insurance. There's a limit on the amount that FDIC insurance will cover, and more than 90% of those deposits were higher than that limit, meaning they didn't get covered by FDIC insurance. Okay, the FDIC, this stands for Federal Deposit Insurance Company. Okay, the Federal Deposit Insurance Company is a government-run insurance agency. The banks pay premiums to them, just like we pay premiums to a car insurance company. If we wreck the car, the insurance company, they pitch in and replace the vehicle, right? So the banks do this. They pay premiums to the FDIC so that if they lose people's money, the FDIC reimburses them, right? There's an insurance claim that gets filed. Okay, now here's the problem. Congress was lobbied and approved years ago that the banks didn't actually have to pay the premiums anymore. So banks have not been paying the FDIC insurance premiums. Because they have not been paying the FDIC insurance premiums, that insurance is underfunded. There's only enough money in the FDIC to cover about 2% of all deposits in existence, which means the FDIC has to borrow money from the US Treasury to bail out the banks when the banks lose our money. Well, the US Treasury doesn't produce revenue. They collect tax income. So who's really paying for the bailouts? We are, with our tax dollars, right? So check this out. We deposited the money. They put our money at risk. They made a bunch of profit. They lost our money. They didn't pay the insurance on our money. Now we have to pay that with our tax dollars today through the FDIC being bailed out by the US Treasury loans. And because the US Treasury is having to expend money to the FDIC, future taxes will go up. we're the ones that pay for this stuff, right? Now, here's the kicker. Here's where it's eerily similar to 2008. Who remembers in 2008 when the government bailed out the banks? Do you guys remember what the banks did with that bailout money? They paid themselves bonuses. Like literally, they ruined the American economy. They caused a global financial crisis. People lost their homes. And the banks, when they got bailed out with taxpayer money, they used that money to pay themselves bonuses. Guys, that is literally criminal. So Silicon Valley Bank, when they failed, last month, literally hours before they failed, the executives wired themselves bonuses. Like, think about this. Like I want you to put yourself in the position of the people that are running a bank, right? Like customers went in, they deposited money. You knew their deposits weren't insured. You weren't even paying for the insurance. You risked the money. You know you lost the money. You know that 90% of that money is not going to be restored by the FDIC. And so instead of taking the profits you had remaining to help your customers, you paid yourselves bonuses hours before the bank closed. Like, how bad would you feel about yourself? That's like next level criminal. Yet this is what happened, and this is who's running the financial institutions. So this is one of the problems we solve. I want to tell you a little bit about my company and what we do. And if you guys are on Instagram here, you don't have the slideshow, so you'll just have to put up with my face and me giving you what we're looking at and reading here. But the vision of my company is called Wealth Dynamics. The vision of my company is to help millions of families, individuals, and entrepreneurs financially fund a life of abundance and prosperity in all dynamics, right? So there's many areas of life. We hear about wealth and people say, well, money is not happiness and you can't buy happiness with money. I believe if you have money and you're not winning physically, you're not winning with your relationships, you're not winning in your marriage, you're not winning in your business or your job, you're not winning spiritually, you're not winning with all aspects of your life, you don't actually have wealth. You might have money, but you don't have wealth. Conversely, let's say you're winning in all of those areas, but you don't have money, you also don't have wealth still. You need both, right? Funding a life of abundance and prosperity in all dynamics. That's what we're about doing. Our other goal and purpose is to build the largest financial services company in US history. So right now we're in the process of recruiting over 250,000 agents and ambassadors across the United States, Canada, and Puerto Rico. And so with this presentation today, I'm going to be sharing with you kind of what's happening in the financial world and the solutions that are out there, especially regarding these bank failures, right? It's very, very hard to fund a life of abundance and prosperity in all areas when there are criminal institutions out there taking away your progress. Like imagine you do all the right things, you save, you earn good income, you pay your taxes, you try and invest wisely, you handle your debt. And because of one institution or two institutions that decide that they want to do something greedy and unethical, you lose all of it, right? That directly interferes and inhibits us from achieving abundance and prosperity in all dynamics of life, right? So we help families, individuals, and entrepreneurs achieve four main things. The first one is financial education. 53% of US adults surveyed say they experience financial anxiety. That's over half of people. Guys, money is right up there with breathing. Could you imagine 50% of us, that's every other breath, like feeling anxiety about where your next breath was going to come from? Right? Like when we're born, there's certain things you just have to do. You have to breathe, you have to eat, you've got to sleep, you've got to go to the bathroom, right? Those are all things we get told, like, okay, you're supposed to do, a job when you grow up. You're supposed to, obviously you need to breathe. Like these are things that we know, but no one ever says also you need to have money. That's right up there. Like imagine trying to live life and not knowing you should have money. And the result of that would be that you struggle because things cost money. So 53% of US adults have financial anxiety. 2 in 3 US families lack an emergency fund. Okay, that's about 2/3 of people. That's 66% of the population don't have an emergency fund. 60% of non-retirees don't think their investments are on track. Okay, and only 1/3 of Americans have professional financial guidance. Okay, now this is just basic math here. We have 2 in 3 Americans that lack an emergency fund. It's 2/3, which means that 1/3 of Americans do have an emergency fund. We have 2/3 of Americans that don't think their retirement is on track, which means there's 1/3 of Americans that do think their retirement is on track. Okay, so what's the correlation here? 1/3 of Americans have professional guidance on their finances. The result of that is 1/3 of Americans have an emergency fund, and 1/3 of Americans know that their retirement and their investments are on track. meaning there's a direct correlation between having professional financial guidance and actually winning with money. Okay, if 1/3 of Americans only have professional guidance, that means 2/3 don't. Well, 2/3 also don't have an emergency fund and don't think their retirement's on track. Do you guys see the correlation there? Right? So this is what we're solving here. Now, we're given two options in life. We're given what's called deferral lifestyle. Okay, deferral lifestyle looks like this, and I'm going to show this to you guys on Instagram. Let me flip you around. Okay, so deferral lifestyle looks like this. Okay, you spend 40 to 60 hours per week serving what I call the 40-year life sentence, trading time for money to hopefully retire one day and die before the money runs out. That's deferral lifestyle. Go to school and get good grades so you can get a good job, so that you can get a good income, so that you can pay off your debt, so that you can save for retirement, so that at 60, you build up enough of a retirement nest egg, and then hopefully the money outlives you. You don't die before you run out of money. Right? That's the goal. Now, that's not the great goal. Like, the real goal should be this: financial independence. Financial independence means passive income from investments that exceed savings, expenses, and taxes, so we can live life now and not be obligated to trade time for money. Right? And so the financial world is teaching the deferral lifestyle. Right? Why would that be? Well, because, if I'm saving money up for the next 40 years before I'm going to use it, who gets to have it in the meantime? Wall Street does. The banks do. Right? The IRS, they get a tax payday at the end of it. Right? Meanwhile, I'm slaving away and working, feeding these guys through fees, letting them invest my money, while I hopefully get something on the back end. And so we teach option number 2 is, how do you build real financial independence? Not retirement, not build up a nest egg, not the 40-year to life sentence thing, financial independence now. Doing this within 5 or 10 years from now, rather than in the next 30, 40 years, and hopefully we have time to enjoy it, right? So here are the stats of the matter. This is the reality. This is actually a report, a quote from the Social Security Administration. 5 out of 100 people will be financially secure at retirement age. 5 out of 100. Right? That means 95% of Americans will not be financially secure at retirement age. Guys, the system is failing us. Do you see that? That's not okay. 5% of people are going to be financially secure. We live in the richest country in the world, and only 5 of us out of 100 are going to be financially secure. And what that means is that when we give our money to the banks, it's not helping us, it's helping them. When we give money to Wall Street, it's not helping us become financially secure, it's helping them. Right? If a statistic is down, the things that are being done to create that statistic are the things creating that statistic. So right now, what are we telling people to do? We're saying, pay off all your debt. We're saying get a 30-year mortgage. We're telling people to put money in their 401ks. We're saying save up in the bank. We're telling people, build the nest egg. The result of those actions is the statistic we see. Only 5% of people are going to be financially secure. Right? If this was such a good plan, why aren't the numbers better? Why aren't more people seeing financial security at retirement age? Right? Now, here's the thing: is the concepts we teach are about 200 years old. Right? And the companies that we work with are very well established. They actually predate the banking system itself. So we use a 200-year-old proven concept delivered by the best team in the financial industry, partnered with companies that have a 100 to 200-year track record of financial stability. So we're not going to be giving you solutions today that are, unproven, or they haven't stood the test of time. They actually predate the very things you're doing right now. Right? Like, for example, Guardian Life Insurance Company. They're a company that's been around since the mid-1800s. Okay, over 150-year track record. They withstood the Great Depression. They withstood the 1950s recession. They withstood, the 1980s crash, the tech bubble in the late 90s, the mortgage crisis in 2008, the pandemic, and they're going to withstand the bank failures too. Right? Like, we want to be using things that are proven, not things that are speculative. The 401k, for example, has only been around since the 1980s. The modern day banking system has only been around since the 1913. The 30-year conventional mortgage has only been around since 1930. The tool that we use is called the sacred account, right? And that's been around for almost 200 years now. So you just look at what's actually worked, what's the actual track record of what we use, and you can see very clearly that one of the reasons why the stats aren't good is we're using unproven financial vehicles. We're using things that have never, like, think about the 401k, 1980. So the average person, let's say they're going to live to 80 years old, right? From 1980 to 1980 to 2080 is 100 years. So that means in 2060, we will have successfully seen the first full generation of people retire and die using the 401k. We don't even know what's going to happen yet. We haven't even seen a full generation of people use the 401k, but we're telling everyone to put all their money into it, right? And it's only been around as long as maybe your dad has been around, 50, 60 years, something like that, the 1980s till now, right? That's not a very long track record. Okay. And this comes down to financial literacy, right? There's a lot of different questions that we like to ask our clients about money. And here's an example. Who here knows the definition between money and currency? Right? The difference between money and currency. Okay, currency is a medium of exchange. You strictly earn it and spend in it. That's it. Right? Money should be a store of value. You can save in it. Most people, they earn $1 and they call that money, and then they save in it. Okay, well, we just looked at inflation last year. The inflation rate reported was like 9%, which means it's not storing your value. Right? So if something loses 9% value, it's not a store of value. It's actually decaying the value, right? It's like putting your food in a fridge where the fridge, doesn't actually turn on and the food rots and you can't eat it later. What would be the point of that? So we should earn in currency, earn in dollars, whether they're crypto, paper, or whatever, earn in them, and then convert those to stores of value. Right? Here's another myth. Who's ever heard of compounding interest? Right? We've all heard the magic of compounding interest. Okay, it's actually been said that Albert Einstein calls it the eighth wonder of the world. The fact of that is that he never actually said that. That's not a quote from Albert Einstein. That's a quote from Security Investment Company in the 1920s or 30s. It was an advertising campaign where they misquoted Albert Einstein to sell more mutual funds. Yet most people think, oh, compounding interest, Albert Einstein, that's the quote. Most of these companies don't actually get compounding interest. When you put money in your retirement account, you're not getting compounding interest if you lose money or you withdraw money. For something to compound, when you lose it, the compounding stops. Compound is brick by brick. You lay one brick, you lay another brick, you lay another brick. So if any moment I lose a brick or don't lay a brick, it's not compounding interest anymore. Same thing if I withdraw the money, I've now interrupted the compounding. So almost no investments actually use compounding interest, yet we hear about it all the time. Okay, here's another question. Are your dollars worth today more today or in the future? Okay, if you save money, is that money worth more today or is it worth more in the future? Right, and this one, like the answer is going to be based on what you do with it. If I leave it in a bank account, it's going to be worth more today because in the future, inflation is going to happen, taxes will happen, and I have less money. But if I take that and I invest that at a high enough rate of return, it would be worth more in the future. Which then flies in the face of the concept of saving. It's not just what you keep, it's where you keep it. If I'm going to keep it somewhere where it doesn't beat inflation and it doesn't increase in value, then it kind of defeats the point of saving money. Right? And I won't go through all these questions, but just the final one here, what is it that you actually know about your retirement account? Like, think about it. Do you actually know how that thing works? Do you know what companies it's in? Do you know why those companies have been selected? Have you looked at the balance sheets of them? Have you seen what the fees are? Right? Like, what do you actually know about your retirement account? Right? You've got your house, which is probably your main asset. Like most people, that's their number one asset. The second one is their retirement account. And the average person doesn't understand the amortization schedule on their mortgage, which is their house. And then they also don't understand how their retirement account works. The top two assets they have in their life, aside from their ability to generate income. They don't know how those things work. Right? Now, here is an example of what we're going to talk about today with the bank failures. Right? So we want to understand how our money flows. So I'm going to give you guys, I'm going to flip Instagram around. I'm going to give you a hypothetical scenario. So let's say that I own a bank and you have $25,000 saved in my bank, and your $25,000 is in an account earning 4% for the next 60 months. Right? So you've got 25 grand saved. You also need to go buy a car. Right? Now you look at getting a car, you could go get a loan from my same bank, $25,000 loan. I'm going to charge you 6% for 60 months. Your monthly payment is going to be $483.32. Right? Now the question here becomes, do I spend my cash over here? Do I take my money out of the bank and spend that on the car? Or do I get a loan from the bank? Okay, conventional math would say, okay, well, we're only earning 4% here on the deposit. The loan costs us 6%. I would rather take the money out because the money is only earning 4% and I don't want to pay the 6. 6 is more than 4, so let's go get the loan. Right? But did you realize that on a 6% loan, you're only paying $28,999 over the next 60 months? If I leave my money and 25,000 at 4%, even though it's 4%, not 6%, my money will grow to 30,525. If I left my money in the bank and I got the loan instead, I actually made $1,526, right? Regardless of the fact that the interest is 6 versus 4, right? The wealthy do not pay attention to percentages, they pay attention to dollars, right? Percentages, if we paid attention to percentages right now, most of us would have chosen 6% and we would have ended up with less money. We would have said, I'd rather spend my cash and not pay the 6% and lose out on the $1,500 profit that I could have made by borrowing, right? And this is just one of those paradigm shifts of, okay, I should spend my cash. In this scenario, the way it's been pitched, I should spend my cash and borrow instead. Or sorry, I should save my cash and borrow instead. I shouldn't spend it. If I save the cash, I make more money, right? The loan, sure, the rate's higher, but I save more. So it's a better financial decision in the long run. Okay. Now, what if you could do both? Okay, the story I just told you in this equation was that it's my bank. You're coming to my bank and you're saying, hey, I've got 25,000 saved in your bank at 4%. I could get a loan from your bank at 6%, right? And that's going to be, I either spend the money that's in my bank account with Jerry Fetta's bank, or I borrow money from Jerry Fetta's bank. Okay, but the common denominator is it's my bank. What if we change just one thing? And instead of a bank, we use something else. We use something called the sacred account. Okay, so what is it? The sacred account is a whole life insurance policy. So what is whole life insurance? Whole life insurance lasts your whole life. It pays a tax-free death benefit to whoever you choose. It is a tax-free savings account. It's 170 years old. It grows at a 3 to 5% annual rate tax-free for the rest of your life. It's guaranteed to grow and guaranteed against loss. It's never lost money. It's only made money. And you're an equity partner in the insurance company and share in their profits. And we would use this sacred account to set up your own bank, right? Rather than, remember in the first slide, we said you're going to deposit the money in my bank at 4%. You're going to borrow the money from my bank at 6%. Well, what if it was your bank and you deposited money in your own bank and you were earning 4% and you could borrow against your own bank at 6%? Okay, because in this scenario, when you borrow the 25,000, the bank's loaning you someone else's deposits, right? Someone else has got money growing at 4%. The bank's going to loan it out for 6%, right? So we flip this, we make it your bank. Now, the sacred account is also a better place to save money than a bank. So when you deposit your money in someone else's bank, we'll talk about the banking quadrant in a second, but as we've seen with Silicon Valley Bank and all these bank failures, your money's still at risk. They put your money at risk. They make massive returns. They pay you little to nothing, and it's not even got stable, steady insurance behind it. When you put money in the sacred account, it's guaranteed against loss and it's guaranteed to grow. Now, it's one thing to guarantee something. It's another thing to have almost a 200-year track record of actually having done those things. Longer than the banking system. It's not taxable, the money you put in there. There's no stock market volatility. There's no wealth management fees. It's protected from creditors. It's protected from lawsuits, and it's got total privacy. You're the only party that controls the contract. Right? So here's the banking quadrant. I'm going to flip Instagram around again because I want you guys to see this. So here's how banking works. Depositors put earned income into the bank. There's 4 groups here. This is group number 1. Okay, the second group is the banks themselves. Banks borrow against deposits to invest. So it's called fractional reserve banking. The depositor puts the money in the bank. The banker then borrows against that deposit. That's why we get interest. That 0.34% on the national savings account is interest they're paying to borrow our money. And then the bank will borrow against those deposits, and they're going to lend that to a borrower, or they're going to invest it. So the guy that's getting a car loan or a mortgage or a credit card, they're actually borrowing someone else's deposits. So in this example of, borrowing money at 6% from the bank, if you were to do that, you're actually borrowing someone else's deposit. The bank is going to loan it out. They're going to pay that person minimal interest, and then they're going to pocket the difference, right? Now, when that happens, the borrower pays interest to the bank makes profit, and there are shareholders in the bank that earns dividends on the profit, right? And so we zoom out on this. We've got depositors putting money in the bank borrowing against those deposits, loaning them out to borrowers, making profit for their shareholders, right? And that's how banking works, right? And in this equation, the depositor is the reason why the whole thing works. If there are no deposits, there's no money to borrow, there's no loans, there's no profits, there's no shareholders. The whole system rides on the depositor, yet The depositor is the one that's given the smallest reward of everyone. Your money is the reason the system works. Your money's put at risk. And what are you making on your checking account right now? Versus what can a borrower make when they borrow money from a bank? They get the privilege of using money. They pay interest. They can go make lots of profit with it. The bank makes the difference between what they're paying you and what they're charging the borrower. The shareholder makes profits on the whole system. So why is it that you're the one that's footing the money for this whole thing and you're getting paid the least out of everybody? Right? Now, I want to go back to our car example. So let's say we made that one change, right? So you're putting money in your bank, not Jerry's bank, your bank, and that bank is earning 4%. And then you're borrowing against your own bank and paying yourself 6%. Right? Let's take a look at that equation because that's much more interesting. Right? So same math here. You put 25,000 into your own bank account using the life insurance. It's growing at 4% for 60 months. In 60 months, your money is worth 30,525. Now, while it's there doing this with your own bank, you can then loan yourself the 25,000. It's still going to grow like it never left. You will still make 30,525 in 5 years. Okay. The difference is you are also able to use 25,000. You pay yourself 6% interest for 60 months, 483.32. Future value of what you paid yourself was 28,999. So you paid yourself this, and then your account still grew to this. Right? You made the interest on the deposit and you made the interest on the loan. Right? This is one simple change. It's a paradigm shift. Instead of using someone else's bank, the only thing you changed here was yourself. You put the same money in, you took the same loan out, you paid the same monthly payment, but the difference is completely night and day. Scenario one, you've got 30 grand. That's it, right? And then you paid interest. So you really only made 1,500 bucks. Scenario two, you've got the 30 grand and you paid the interest back to yourself. Right? Can you see the paradigm shift there? It's the same everything other than the fact that you own the bank now. And this is a concept that's been around for 200 years, right? Now, here's the reality of what happens with banks. Like, I want to show you guys this because it really puts it in perspective. So let's say you deposit $100,000 in the bank, right? You put it in, right? You're going to make 4% on that money. Now, 4% is generous, right? There's not a bank out there actually paying 4% right now. So the bank takes your money, they're paying you 4%. They loan it out on a home mortgage. They're going to charge the home mortgage 7%. So they charge 7, they pay you 4, they're going to make 3%. The guy with the home mortgage, when he buys the home, that money from the home goes to the seller. So the seller makes the money from the home sale, which goes back into the bank. Okay, so the bank just got the money again. Okay, now the bank loans that money out. They're still making this over here. They've now loaned that money out to someone on a car, right? They're charging 8% interest on the car. They're making 4% deposit payments to this person on interest. And so the difference is they're making another 4% here, right? So when they do the car, the guy that got the money from the bank to buy the car pays the car dealer. The car dealer takes his profits from, selling the car, and where does he put that? He puts that in the bank. Okay, so now the bank is paying him 4%. He's going to take that money, they're going to loan it out to this guy on a home remodeling loan at 9%. So they're charging 9%. Sorry, they're charging 9% in interest to the home remodel, paying 4%, they're making a 5% profit. Okay, the home remodel guy takes his money and he pays the construction team. Okay, what does the construction worker do with the money that he got from the home remodel? Well, he deposits it in his bank. So then the bank takes that money, they loan it out again on a debt consolidation loan at 12%, right? And then that debt consolidation loan is used to pay off the credit card companies. What do the credit card companies do when they get the money? They put it back in the bank, right? And in this sequence, the bank is making a 3%, 4%, 5%, 8% spread. That's a 20% annual spread on the same 100 grand. Guys, they're paying 4%. They're making, literally 500% more money than they're paying the depositor, right? If you ask yourself, why do banks do what they do? I think that's the wrong question. The right question is, how the hell are they failing? If you're making 500% returns, how is it that you're not staying in business right now? And I've got zero sympathy for them, because if I had the opportunity to do this, I would be wealthy. I don't think I would ever do this because it's unethical, right? But this is what the banks are doing. They're really making this kind of money. Okay. Now this is from Bauer Financial. Banks make between 400 to 1,300% on your money when you leave it there. 400 to 1,300% on your money. Guys, this is insane. Like 400 to 1,300%. I want you to think about that. 100% is double. 400% is quadruple. 1,300% means they're making 13 times what you've put in there, what you're making on your money. They're making 13 times that on your deposits. And they're putting zero skin in the game. Right? So this is, again, back to the banking quadrant. Here's the issue we talked about is there's depositors, there's bankers, borrowers, and shareholders. What if you could be all four? Right? Just to bring Instagram back into this, we talked about this quadrant, right? So what if you could be all four? You deposit money into your own bank. You then borrow against the deposit. You loan it out to invest, and then you profit from the system. What if you could actually do this? And with the life insurance, with the sacred account, you actually can. You deposit money into your system. Now, we talked about this is the safest place you can save money. You're going to earn 3 to 5% per year for the rest of your life. It's tax-free, all the benefits there. So as far as a place to deposit money, this is a really good one. Okay. Now, by being a depositor with this life insurance, I'm going to skip ahead a little bit. The insurance company actually makes you an equity shareholder. They make you a partner in the insurance company. As a partner in the insurance company, you get to borrow against your own deposits like the bank does. So you actually can borrow against your deposits. And the math on this is, if you're depositing money in, you're going to make about a 3 to 5% return. That's not the right pen there. You're going to make about a 3 to 5% return. And then your interest cost, if you set this up right, you're going to pay about 1 to 3% interest. When you borrow, you pay the interest just like the bank does. Your deposit still makes what it's earning, just like what the bank would. Okay, the difference is you're making more in your deposit than what your interest cost would be. And that's between a guaranteed interest rate you make on your deposits and also dividends you make as a shareholder. And the combination of that is going to be about 3 to 5% growth per year, right? Now you borrow against your deposit. Now let me just handle this. Why would you borrow against your own money? Let's handle that question really quick because this comes up sometimes. Why would I borrow? Why would I borrow against my own money? So there's two reasons. If I have an asset, right? Like let's say I invest in something that's growing. If I have an asset, if I sell an asset to get cash from it, what did I just do? I just lost out on my growth. Like the thing that was growing, I just got rid of it. I sold it. I don't get the growth anymore. So as an investor, you never sell a producing asset, right? The other thing that happens if you sell an asset that was producing and growing and you made profit, you've also now incurred taxes. So there's two things that an investor hates doing. It's losing an asset and paying taxes. When you sell a productive asset, you do both of those things. You violate both of those rules, right? You'll hear Warren Buffett say, rule number 1 of investing is never lose money. Well, if you sell a productive asset, you've just lost money. If you pay taxes, you've just lost money, right? So rather than sell, you borrow. Okay, when I borrow, I still have the asset they're growing. I can use the money that I've borrowed. And also loans aren't taxable. So I've solved my problem of wanting access to the cash. Like if I sell an asset, it's because I want the cash from the asset. I've got a liquidity issue. I need cash, right? So if I borrow against the asset, I solve that problem. I can use the money. I've got liquidity. I've got cash. But also I'm not losing the asset, right? And then also I'm not paying the taxes. I've now avoided the taxes. So I solve all of those problems. Right. And that's why we would borrow. Here's an example of this. You guys all heard about Elon Musk maybe 2 or 3 years ago. He was in trouble for, paying hardly any taxes. Well, he was borrowing against his Tesla stock. That's why. Loans aren't taxable. So you borrow against stock, you don't pay taxes. The stock keeps growing. You avoid the taxes. The result is Elon is now the wealthiest man in the world. Right. Like it's something that's been around for a very long time. So again, it comes back to, like we talked about at the very beginning of this, it actually made more sense to borrow money for the car loan than to use my cash. Same rule applies here, right? So I've got the deposit. I can bank against it. I can borrow. I can then use this. I can pull this money I've borrowed now, loan it to myself, and I can use this to pay off debt. I can use this to make large purchases. And I can use this to invest. I have a client that Bree and I are working with right now. He is going to be using this to pay off about $200,000 worth of business debt. So rather than putting $200,000 towards the debt, he's going to borrow it from his life insurance policy. He's going to deposit it first, borrow from his sacred account, use that to pay off the debt. While he's doing that, the 200 grand grows like it never left. And then he makes payments back to his bank rather than to the other bank he makes payments to now. Okay. And then at the end of all of this, you earn dividends. Because you're a shareholder in the insurance company, you get paid a dividend based on the insurance company's profits. So the more that company expands, the more dividends you earn. You want more people borrowing. Like, imagine if you got paid profit on the bank. When people took loans against your deposits from the bank and the bank made profit, imagine if they shared that profit with you. You would love the system. You'd be like, that's awesome. We're helping people. We're giving them money. I make money when they make money. Everyone makes money. It's a win-win-win all around. The difference is that you don't make money. The bank keeps all of it, and then they lose the money, go under, and don't pay you your deposits back. Then you find out there wasn't insurance in place on it, right? So this is the banking quadrant of you could be all four. You can be the depositor, you can be the bank, you can be the borrower, and you can be the shareholder. But again, no one ever taught us this. So what does this actually do, this life insurance? So number one, you deposit funds into it. Okay, you deposit funds into it, you have access to 70 to 90% of what you deposited immediately. So if I deposit like 100,000, for example, my 100,000 is there, it's growing. I can borrow against 70 to 90% of that immediately. My funds grow, even though I'm borrowing against them, they still grow at 3 to 5% per year on average, tax-free. I can borrow against the available funds. I can use them while my money still earns 3 to 5% like it never left. This is the double dipping part, right? This is what the banks do to your deposits right now. My cost of borrowing when I do my loans correctly is 1 to 3%, meaning I'm making profit on my earning rate minus my loan interest rate to borrow my own money as the banker. Okay, I use the borrowed funds to pay off debt, make large purchases, or invest. I then pay myself back at my own pace and on my own schedule, right? That's how this works. Now, here's an example. I have this drawn out for you guys. I'll turn Instagram around for this one too. So check this out. We'll just show you with the dollar. So you have a dollar here. Okay, you put the dollar into your banking system, right? This dollar is now going to grow at 3 to 5% per year for the rest of your life. Now, let's just look at from year 1 to year 10. Okay, from year 1 to year 10, your dollar will turn into $1.50 just because of that annual growth. While it's doing that, in year 1, you can borrow 80 cents. You're going to pay 1 to 3% interest to do so. Keep in mind, you're still earning that 3 to 5%. This 80 cents you've borrowed, you're going to go invest and make 8 to 12%, right? So let's just say you took 80 cents and you made 8 to 12% on it. That's great. But what if you took 80 cents and made 8 to 12% on it and also 3 to 5%, right? You can have your cake and you can eat it too. Okay, now you take this money you're making and you pay your bank back, right? When you pay your bank back, you're replenishing the money you can borrow again so that in year 2, you can do it again. And you can get another thing paying you 8 to 12%. Let me ask you, if you could borrow, get an asset, pay yourself back and reborrow, how many times would you want to do this between year 1 and year 10? Knowing that your initial dollar is still growing, knowing it's going to turn into $1.50 anyways, how many times would you want to do this consecutively? How quickly would you want to borrow, repay each time knowing you're securing another asset that pays you 8 to 12%? Right? My answer would be infinite. This concept is called the infinite banking concept. The tool we use is called the sacred account. It's a life insurance policy, but the infinite banking concept is the concept of infinitely borrowing against your money, doing the same exact thing the bank's doing, right? Now, I'm going to give you some more examples that are going to blow your mind a little bit, but this is the basic concept of it, right? So I don't want to get into the weeds too much. I'm going to skip a couple of slides. So there's 3 rules with your banking system. Rule number 1 is you always pay yourself first. Rule number 2, you always pay yourself with interest. Rule number 3, you recycle and recapture your money, right? And you can do this with like a car, like we talked about today. You can do this with debt. I'll give you an example of someone that has debt, right? So this is a real client case, and I'll flip Instagram around again for this one. This is a real client that had $478,000 in debt. Total monthly payments was $5,777 or $69,324 per year. They are going to be in debt currently for 19 years. Right? Here's all the debts they had. Here's all the balances, the monthly payments, the interest rates. Okay. So we set up the sacred account with this client and they're depositing $25,000 a year into it. Okay. Year 1, they can borrow $14,863. So they deposit $25,000 in, they can borrow 14. They use that to pay off their Discover card and Lowe's. They no longer have the monthly payments. They're no longer paying the interest. And realize if you pay off a debt that was charging you 21% interest, you just earned 21% interest by not paying it. right? They still have all these other debts, but let's just look at what we're doing so far. We've reduced their balance, but their monthly payment has just dropped. Okay. So their monthly payment went from $57.77 down to $53.29, and they're saving $488 back into their life now. They're putting that as loan repayment because they don't owe that to another bank. They can pay it into their own bank. Do you see that? Now, next step of this, they do another deposit. The second year, they put in another $25,000. Okay. They have $16,571 in cash value. They're paying $53.76 a month towards their debts right now. Total cash they've got available between loan repayments and contributions is $21,945. And again, that's because they were paying $448 a month back to their bank instead of the other bank because we paid off those first two debts. So we've got $21,945. This client, he takes that and he pays off Nordstrom, he pays off Wells Fargo, he pays off his loan. Okay. He has saved himself again another 21% interest, 3% interest, 10% interest. His payments dropped again. He freed up a $1,917 a month total, which he's now saving back into his bank. And then he is only paying now $38.60 a month towards his debts instead of that initial $5,700. Okay. So year 3, we go down, he does it again. He deposits another $25,000 in. Okay. Now he's got $25,541 in cash value because of the growth. He's paid in loan repayments, $23,004. So he has $48,545 in total cash. Right. And that's again because he had $19.17 a month. He was contributing in loan repayments plus his $25,000 of deposits. So he takes this $48,000 and he pays off the next two debts. He pays off BMW, he pays off West Marine. Right. He frees up, a couple $100 a month here, $1,200 a month here. He's saving interest. And so his monthly payments drop once again. Right. Now we go into year number 4. Okay, so we've paid everything off except for at this point the condo and the house. Like let's keep track of that. So this is all his non-mortgage debt. We go into this, and so far we put in year 1 $25,000. Year 2 we put in $25,000. Year 3 we put in $25,000. That's the only new money he put towards this. Right? He contributed $75,000. So he contributes $75,000. In year 1 he paid off a loan of $14K. In year 2 he paid off $16,000 in loans. Year 3 he paid off $25,000 in loans. So if he put in if he put in $75,000 and he took out $55,000 to pay off loans, how much is left in his policy? See, conventional math would tell us 20. You put in 75, you pulled out 55, you've got 20 left. But because his money still grows like it never left, he still has 75,000 in his policy. Right? If he would have used an ordinary bank, he would only have 20,000 left. If he pulled out 55,000 of his own money, he would only have 20,000 left, right? If he uses his bank, he's still got the full amount there growing, right? This is the power behind this concept. Right now, let's continue with this because he does go after the rest of his debt here, right? So he's now only making $2,100 a month in actual debt payments. He's now paying more to his bank than the other bank. He puts in year 4, another 25 grand. He's got $26,000 in cash value. He's repaid loans of $44,124. He's got total cash of $70,428, right? So he's only got $250,000 in debt left at this point. So he does this again in year 5. He puts in another 25. That puts his cash value at $27,090. Payments is $54,672 on loan repayments. He's got total cash of 81 grand. And he basically borrows against this in year 4 and 5 to pay off the condo. So he pays off the condo. He's now only paying $1,221 on the house, right? He's paying $45.56 per month back to his policy loan, right? And he's growing his banking system. And then in year 6, he pays off the house too, right? He only deposits 10 grand in, right? He has cash value here as payments. He's got total cash of 97,000. The balance on the house is 76,000. So he borrows against this 97. He pays off the house entirely, and he's completely debt-free in 6 years. Not only is he completely debt-free in 6 years, he's now saving $5,770 per month back in his policy. And all of the money he deposited is still there growing like it never left. Right? Now, let's say that he kept on doing this. And this is, by the way, this is something all of our clients get. If you have consumer debt, we actually will build you a debt map. So if you're trying to pay off loans and you're working with us in our mapping team, with the money multiplier, we'll do a debt map for you. We'll show you here's exactly what you should do, right? Now, if he continued to pay the homes back as promised, right? Just that, no interest, he would pay himself back $493,967. Right? Now, because he's paying it into his sacred account, if he pays his homes back to himself with 4% interest, he actually would have $749,611. Okay, that's on top of the money he contributed. That's on top of his cash value growing. That's just him continuing to pay the condo payments back. Right? Like, think about that. That's $749 that factually he would have paid to his bank, but prior he was going to pay to their bank. This money was already going to leave his pocket. It was going to go to another institution. It was going to make them wealthy at his expense. Now he gets both. He gets the value of the condo, he gets the growth of the money he's using to pay it off, and he gets the interest. Okay. Now this also works with investing. You can invest with this. You can borrow against it and invest. If you were to do $100,000 real estate deal with cash, you would make about 60 grand over 5 years. If you do $100,000 real estate deal same way, but use the sacred account instead, you would make 66,643. You're making almost an extra 7 grand by using the sacred account instead of cash. You see that? Right? So, and then by the way, we didn't even talk yet about the death benefit, the fact that loans never have to be repaid, the internal values grow tax-free, policies are exempt from judgments and liens in most states. Like, there's a lot more benefits, right? But what this is a life insurance policy. And I'm going to flip you guys back around on Instagram. In life, there's only 1 or 2 things that are going to happen. You either live or you die. So if you live, are you better off with this system or without it? Are you better off being your own bank or giving all the money to someone else's bank if you live? Right? If you die, you have a death benefit with this. Your family, your loved ones are going to get more money tax-free than you actually had built up. The death benefit is always higher than the cash value. So they're going to get more money than you even save. So if you die, are you better off with the system or without it? Okay, and so for me, the answer is in both scenarios, I'm better off with it. I'm better off with this system if I live. I'm better off with this system if I die. Right? Now, we've kind of gone over this. What I want to hit on this is, again, one of my purposes is to share the truth about money with those around me. I want to impact millions of people with this concept. So now that you know this, everyone should too. Who do you know that could benefit from this concept? Right? Like, how many people do you know that have no idea that this information is true and they can apply it in their lives, that are giving money to the bank, that don't know they can be their own banker and they can make all the money the bank's making on their behalf? Right? So there's a quote from Warren Buffett. This quote goes like this: if poor people would just do what the rich people do, they wouldn't be poor anymore. Right? I'm showing you what the rich people do. And I'm going to prove it to you that this is what they do. I don't even want you to take my word for it. I want you to look at only the data. Okay? Banks are the #1 owner and purchaser of high early cash value, dividend paying whole life insurance on the planet. The very system that I just showed you, the #1 owner of this type of life insurance are the banks. Guys, not only are they taking your deposits, not only are they borrowing against it without your permission, not only are they making 400 to 1300% on your money and then losing it and paying themselves bonuses when they fail, not only are they profiting from that system at your expense, they're taking their profits and they're putting it in the exact thing I just showed you. Okay, this is as of 2018. Okay, these are the top 10 banks, right? Top 10 banks. This is just the top 10. $82.7 billion in life insurance cash values. 13% of their reserves. Guys, this is only the top 10. There are over 3,000 banks that are using the system, right? When you were a little, maybe your bank still does this. Who went to the bank and they would give you a sucker when you leave? Who remembers that? Right? How fitting is it that you go in there, you give them the money and they reward you by giving you a sucker? It's because when you do that, you're a sucker. They're trying to tell you something there. Not only that, there's a specific brand they like to use. Okay, on the wrapper, they make sure that the sucker says dum-dum. Even the banks know if you're giving them money, you're a sucker and you're a dum-dum, and they give us that as we leave the bank, and they're going to take our deposits to go make millions of dollars, and what we get in exchange for that is a lollipop. Right? Like, this should make you mad enough to want to do something about it. To say, okay, I'm at least going to learn more. Right? Maybe I don't jump in right away and I change my whole life around the concept, but I'm at least going to set up a call with Brianna. I'm at least going to set up a call with Jules. I'm at least going to get the book. I'm at least going to do myself and my family the benefit of learning more about this information. because no one else is going to teach it to you. You think the banks want you to know about this, right? Who else has used this in history? So like we said, the largest banks in the world, Joe Biden actually owns 6 of these life insurance policies. The president of the United States, right? He probably does not remember that he has the first 5, bless his heart, but he owns 6 of them. Okay. J.C. Penney, Walt Disney. Okay. Walt Disney actually started Disneyland with a loan from his life insurance policy. Ray Kroc funded McDonald's with a loan from his life insurance policy. Foster Farms, Stanford University, John Rockefeller. If you're a Rockefeller descendant, you do not get to take money out of the Rockefeller family trust if you don't have a life insurance policy like this. They literally have it as a rule in their trust provisions. Senator John McCain, Pampered Chef, Joaquin James Malfers, otherwise known as Waka Flocka Flame, President Theodore Roosevelt, Sam Walton is another one. Like, these are the people who are using this concept throughout history, right? So this is not your brother-in-law. And here's one of the things that's always going to come up as a question. Well, if this is so good, why don't more people know about it? Okay, we'll talk about why in a second, but let me just point out this. How many of your friends and family know they should go to the gym and don't? How many friends and family of yours and your peers know they should donate money, yet they don't? They know they should eat better, but they don't. They know they should, wake up in the morning and write their goals down, and they don't. They know they shouldn't watch crappy TV and listen to music, and they do it anyways. Like, people aren't big on doing the things they know they should do and not doing the things they know they shouldn't do. In fact, that's to the point that when I was 19 years old, a mentor told me, Jerry, you'll be successful in life if you look at what most people do and you just do the opposite. Just do the opposite of what the masses are doing and you'll be successful, right? So that's the first part of that. But the second part is not about how many know about it, because a lot do. The 1% are using this. 1% of American population is 330 million total. That's 3.3 million people that do know about this. 3.3 million people is a lot. That's not a small number. It's not like 4 people in the back of some smoky room know about it. Millions of Americans already do know about this, right? And it's not about how many know, it's about which ones. Do I want the financial advice of my buddy at work, or do I want the financial advice of John Rockefeller? Like, who am I going to listen to? Who's got the higher statistics? That's who I want to be following, right? Now, there's another quote from Will Rogers. He says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Right? Back to this fixed idea thing I mentioned at the beginning, this uninspected belief, oh, put your money in the bank, put your money in Wall Street. Guys, that's marketing. When you say something enough times, loud enough, and put enough money behind it, it becomes the truth, no matter how false it is. And banks and Wall Street and the IRS have put a lot of money and a lot of repetition behind you guys thinking you should put money in their systems, right? So millions of people do know about this. Banks, they don't make money when you use the tool. So this is another reason why you wouldn't know about it. Who's the number one retail financial product salesman in your life? It's your bank. They want you to get the car loan from them. They want you to get the checking account from them. They want you to get the insurance from them. They're loading up on products. Here's all the things you can buy. This is the only one they don't make money on when you buy it. They make money on it when they own it. They don't make money on it when you own it. So if you start using this system to become your own bank, and you no longer deposit money in banks, and you no longer put money into loans, and you start doing it all yourself, what's going to happen to the banks? They're going to fail at an even faster rate. So there's no reason for banks to want you to know about this. Same thing with Wall Street. They don't make money if you use this. Okay, the IRS, even when you put money in your life insurance, you never pay taxes on that money ever again. Never again. So do you really think Wall Street and the IRS and banks want you to know about this? There's no incentive. Those who market the financial world to you, they lose money when you do this product. They have no reason for you to know about this. They don't want you to know about it, yet they use it themselves. Right? So why is this better than the alternatives? Your alternatives at this point is you can keep using the bank. You're going to get minimal interest and your money will be put at risk. You could use retirement accounts instead. You're going to get market volatility. You can't access your money until your retirement. And your fees are going to eat away at the account regardless of performance. Or you can use cash. Cash is going to go down in value year after year. And so this meets all the marks of being the optimal place to save money. It's been around longer than all the other systems out there. It's more reliable. It's got more benefits. It puts me at control in that cause. And on a wide scale, it helps everyone. That's why this is a better system. Right? So you have a couple of options with this. I'm going to wrap up here and answer some questions if you're watching. Option number one is you can watch this and be like, okay, cool. This was just another webinar. I'm going to go on with life and keep putting money in the bank. I'm going to completely ignore all the things I learned today, right? That's called denial, right? Denial is, I can't help you if you're in denial. If you watched all of this today and you're not at least in the band of skepticism where it's like, this sounds cool, but I want to learn more. If you're not at least there, I don't know what to tell you. Okay, financial freedom won't be a reality for you if you're so comfortable with the current scene that you're not willing to actually make a change when it's better for you. So that's going to be the first option you have is denial. The second option is skepticism, healthy skepticism. Okay, this is new. I want to take it slow. I want to be conservative. Let me learn more. I want to invite you to do that, right? So set up a call with my team. If you're on Instagram, drop in the comments. Let us know that you want to set up a free call. If you're on Zoom, answer your chat. Jules and Bree are reaching out. Let them know, hey, I want to do a call with you. I want to get more information on this. I want to learn more. I'm not totally sold yet, but more data for sure will help. Okay, that's the second group. The third group is the action takers. Okay, I was actually in the second group. Guys, when I learned about this concept, I was like, this looks like a unicorn. I don't even think this is real, right? And so I actually did about 30, 40 hours of research myself to determine that this was real. Once I realized it was, I moved into group 3, which is the action taker. This makes sense. I'm doing it. I'm ready to go. I have clients on this webinar right now that their lives have been changed by this concept. My life has been changed by it. We know it's real. The only difference comes back to what I said at the very beginning, which is knowing the vocabulary, understanding the words being used, understanding the concept. And that's just learning. That's why the book is there. That's why our endorsed wealth mentors are here. But if you're ready to take action today, I want you to reach out to my team as well and let us know, say, I'm ready to take action. I've seen enough information to make a decision. This makes sense for me, right? I want to take control of my own finances. Now, here's the catch. I'm going to give you the catch here, right? The catch is not that this costs you money because it actually costs you more money not to do it, right? When you put your money in the bank and they make 400 to 1300%, that means you aren't, right? They're making that instead of you, right? The catch here is you have to be responsible. You have to fund your own bank. It's the 3 rules we said. You need to pay yourself first. You need to pay yourself with interest. And you need to recycle your money, right? And that means that you can't just give this to someone else and expect it to happen. You actually, it's like buying a car. You have to drive the car now, right? And that's the catch. This is not for someone that they want, the convection oven financial plan of put it in the oven at 350 and hopefully when I'm 60 years old, it's done. Okay, this is someone that they want to be involved. They want to learn. They want to grow. They want to have their hands in Indian and they want to be responsible for their wealth. And that's the catch. It's going to require that you have knowledge. It's going to require that you take responsibility, and it's going to require that you have control over your finances. And if you're not interested in those 3 aspects, then this is not the plan for you, right? But if you are, this is the perfect plan for you. So I want to open this up to some questions. If you guys are on Zoom, go ahead and drop your questions in the chat. Same thing with Facebook and Instagram. Good to see everyone on the gram, by the way. We did a live stream on this week. I haven't done a live stream in a little bit, so we're going to start doing those again. This was our first one of many more. Let me just check what we have in the chat for Zoom first. Someone asks about the recording. So the recording will be on my YouTube channel. It also will go on the Wealth Dynamics podcast, which you can find on Spotify and iTunes. Victory says they're gonna subscribe. That's awesome. Good. Let me see if we have any other questions. Good. Bree says when the Social Security Administration is saying only 5 out of 100 will be secure for retirement, it's time to pay attention. 5 out of 100 is a failing grade. That's a super, like I think in school, I'm pretty sure below 60% is a failing grade. So if you're like, that's an F, I mean, 5% is like, it's dismal. It's not even a grade because it's so low, right? But Bree makes a very good point there. We have a question about precious metals. Does the government look at the precious metal program that you will promote? I have a government benefit that limits how much money I hold in accounts. So I would say, and James, this might not be the answer you're looking for, but I would say that if a government benefit limits you from building wealth, I would get rid of the benefit. I would focus on increasing my own means, my own income. I would own as many assets as I can, even if it meant I was going to lose the benefit, because the reality is you could do better than that, right? So, I don't know how they're going to look at the precious metals. That's something you'd have to check with that government agency. But I would say like this goes for like, let's say student loan forgiveness programs. They'll forgive your student loans as long as you make less money than this number for the next 10 years. Screw that, go make money, right? Never stop earning and expanding because of what the government might do. James asks, I'm assuming this is an increasing value policy through which just enough money is contributed to policy to ensure it is not a MEC. All contribution increases. Yep, that's true. So there's something called a MEC. MEC is a contribution limit. If you put more money in than that number, it becomes taxable. So we do want to increase the value and stay under that number so the policy retains its tax benefits. Michael asks, how do the insurance companies pay you when you withdraw from the policy? So the insurance company, when you deposit money with them and you borrow against it, your money is allocated fully. So unlike the banks, they're not loaning your money out. It actually is there, like it's staying inside the insurance company. So your money is actually there. When you borrow against it and take a loan, they're literally giving you a loan against your money. Your money is truly there. So that's how they pay you, is the money that you give them, they actually have, unlike the bank. And guys, if you want to test this, if you put in more than maybe, I don't know, 50, 60 grand in a bank account, and then you ask them for that money, they're not going to have it, right? It's going to take time. We had a client last year, he wired $500,000 from his bank account. His bank had to contact the Federal Reserve Bank of the United States and ask permission for this client to have his $500,000 wired to him, because the bank didn't have it, right? They didn't have it. The reason why they had to ask permission is because the bank had to go get a loan from the Fed for $500,000 to give this client his money back, because they don't have it. They loaned it all out already, right? So that's the system. So guys, I don't see any other questions on Zoom. Let me check Facebook really quick. All right, I think we're good there. I don't see anything on Instagram. All right, guys. So special offer really quick. If you're watching this today, I'm doing a webinar tomorrow as well. What's up, Bracken, Eoin Bracken, good to see you. I'm doing a webinar again, 5 p.m. tomorrow. I'm talking about personal development. There's a book that I read that changed my life, and I want to share with you about it. I've never really talked about this before. And so I'm going to go in depth on this. It's going to be at 5 p.m. Eastern time tomorrow, right? If you go to, I believe it's improve.jerryfetta.com. Let me make sure I've got my URL correct. Yeah, go to improve.jerryfetta.com. For anyone that goes to this event, you're going to get a free ticket to my arena bootcamp. Okay, on June 6th, June 6th, June 3rd. I've got my dates completely flipped around. June 3rd, I'm doing a digital bootcamp with 6 of my very closest friends, very powerful business people, speakers, that we're going to be teaching an event from 1 to 7 p.m. And so if you attended today and you also attend tomorrow, you're going to get a free ticket to that bootcamp, right? And the bootcamp, if you already bought a ticket, we're going to give you a +1. You can invite someone in your life, whether that's a spouse, a best friend, a business partner. I don't care who it is. You're going to get an extra ticket to give to someone, right? And the speakers at this event, we've released the first 3. The first one is my partner and friend, Ivan Ans. Ivan is the youngest family office founder in history, right? He has a multi-$100 million family office, businesses all over the world. And so he's going to be speaking. The next speaker is a guy named Manuel Suarez. Manuel Suarez runs one of the top digital marketing agencies in the country. He's marketing for people like Chick Corea, the lady that does the voices on The Simpsons, right? Like very high profile people. And so they're going to be sharing their stories. We just released another one, which is my friend Brenna Fox. She's a former US Marine. She's one of the top fitness influencers. She's a top Legionnaire with First Form. And so she's going to be speaking as well. We've got a few more speakers we're going to release this week. And so I want you to stay tuned for that. But again, you can get a free ticket by going to the event tomorrow. So if you go to improve.jerryfetta.com, Instagram, let me put this in the comments for you guys. If you go to improve.jerryfetta.com, that's the link. And if you go there, you can register. right? And that's going to be the event tomorrow. And that event itself is worth its weight in gold. Like that's going to be tremendous personal development education. That's going to give you quite a bit of just resources and materials you can use now. And also it unlocks that ticket for you. So guys, that's all I've got for you today. Thank you for watching. Make sure that you like, share, follow. I'll see you all again next week. And I'm going to leave Bree in charge of the meeting room. Last week I said I wouldn't, didn't on accident. I'm going to leave Bree in charge so she can connect with you and network with you. If you want to set up a call, definitely do that. So check your chat, and make sure that you connect with Bree. So let me turn this over to her. Otherwise, guys, have a great weekend. I'll talk to you tomorrow.